Are government tax-free bonds a good tool for income in retirement?
They can be. The problem is you have to understand the liquidity provisions and how long do you buy a bond. So when you buy a bond at face value, $1,000, it's going to pay you an interest rate. Today, that interest rate is 4% on a 10-year bond. So basically about 4%. I'm just giving you round numbers here. So if you give them $1,000, they're going to pay you annually $40 in interest. So you're getting a 4% rate of return. If you hold that bond to maturity, Chip, in 10 years' time in this example, they will give you back your $1,000. And then, of course, you could buy another bond in it. Now, the problem with that is the 4% that you're getting today enough income? And the answer is almost always yes, year one of retirement. In fact, there's what's called the 4% rule, right? The idea that, so if you had $1 million, you could pull $40,000 in interest. The problem is inflation starts to erode your spending power. You're going to need $41,200 the next year, and then $43,000, right? And because of inflation, at averaging about 3%, you're going to need more income every year. So the income from those bonds will not keep up. Therefore, it cannot be the only tool that you use. So the other problem is interest rates change the value of bonds every moment of every day. When interest rates go up, bond prices go down. It's an inverse relationship. When interest rates go down, bond prices appreciate. They go up in value. So if you understand this, you would have a laddered bond portfolio if you're going to use them. In other words, diversified maturities, 2-year, 5-year, 7-year, 10-year, 20-year, et cetera, right? So you would ladder them across different maturities because they're going to react differently to those interest rates moves. And you want to also make sure that your portfolio would have some sort of equities on the other side of it, something to grow to keep up with the inflation. So bonds can be used for the short term very easily, especially when interest rates are set higher at the moment, so you're buying at a decent interest rate. When I started my career, Chip, we had treasuries in double digits, and people would kill for that today. I mean, literally, could you imagine getting the federal government guaranteeing you 30-year interest rates at 13, 14, 15%? That's literally what was available when I walked out of high school, right? You could buy a U.S. Treasury. And on top of that, as interest rates came down over that 40-year period, those bonds appreciated substantially in value.
Oh, well, what's typical now? Like a half or a quarter of that? Or what?
Yeah.
What's typical
so
in the bond
like
markets
today,
now?
the average bond portfolio is going to yield you less than 3.5%, right?
Yeah.
Because you're going to have some shorter duration in there. And on top of that, when the interest rates just moved up the last couple of years when they did, you lost about 8 to 10% in appreciative value. So you actually were negative on the return. So bonds, you've got to be careful, understand timing, when to use them in the portfolio. But you also need to understand, depending on what tax bracket you're in, you might want to slide out of government bonds from the federal government and into municipal bonds issued by a municipality in the state with which you live, especially if it's a taxable income state like we live in here, because you may have a higher tax equivalent yield. And we can calculate all that for you. But yeah, there's a lot there to understand, what you'd want to look at. But with our debt spiraling out of control at $38 trillion, you may want to be really careful how much you're willing to trust the government on those bonds, right? Because governments will have to make some austerity moves. We've seen that in Europe already. I don't know if that's coming to the U.S., but it's something we're certainly paying attention to. Hey, if you're looking for more content like this, make sure you check out these videos, and don't forget to like, subscribe, and ring the bell so you'll be notified when we publish more content that will help you retire smart. Thanks for watching.